Today, we're going to unpack an important idea around our investing and choices around our investment. And oftentimes, if you listen to episodes before, we often talk about it doesn't matter what you invest in; it matters how long you invest and that you invest. And that we always, say it's about getting started and not letting analysis paralysis affect, your choices. Now, however, today we are going to unpack some specific scenarios specifically with the client who reached out to us through YouTube and has been watching us for a long time on our YouTube channel. And we unpacked their unique situation because even though we have said, it doesn't matter, it matters. It matters. So there's two parts, it doesn't matter that you start investing and you are choosing appropriate asset classes, is that you are investing. But it does matter in your situation, maybe which asset classes make the most impact over that long term for you. And that's what we're going to unpack here using this case from a client of ours who reached out through YouTube.
Awesome. Yeah. And, John, I had an awesome opportunity to chat with this individual. Has a lot of great things going on. And I also want to add to, you did a good job highlighting the idea between, it's almost like stages, right? As you had mentioned, it's like get investing in anything. Get investing. Great. As you get investing, then you start to think about, okay, what should I be investing? Okay. And then as you start to recognize, you know what, I want some in this, I want some in that. Maybe you want some real estate, you want some stocks and bonds, maybe you want some commodities, maybe you want gold and silver. All of those things, like you can figure that out as you go along the journey. But then once you figure that part out, we are now at a stage where you start thinking to yourself, where should I be investing in these things? So a good example here doesn't apply to the client we were chatting with, but just to give a nice example to frame this is that, when I'm investing in my RSPs, tax-free savings account, and unregistered accounts, which should I be investing in where? That can matter, right? Yes. Why can that matter? Well, guess what? If you're not going to get taxed on anything in the tax-free savings account, guess what? I'm open to earning quite a bit in terms of, say, capital gains or dividends or interest because it's all going to happen tax-free. Whereas if it's in an unregistered account, I might think about doing things like capital gains only, because then I'm not going to realize those capital gains until I sell. So there's a lot of things that we need to be thinking about, and it gets even more complex as you start incorporating real estate into the mix, incorporating for your business or your real estate portfolio, for example. And in this particular case, we want to kind of highlight a scenario where just simply deciding where to make specific investments can have a massive impact on the total net worth of this individual over the long term, but then obviously the amount of cash flow they're going to be able to create for themselves as well.
Yeah. Because I think it's like, when we talked about the act of getting started with investing is really about learning the behavior and the pattern of this is who I am and I am an investor and I do this is more important than say what initially. Once you have established that pattern behavior, that this is what you do, then you start to move from phase 1 into phase 2 into phase 3. And phase 3 is about now going, how am I protecting my pile? How am I protecting the hard-earned capital? And that's when we start to optimize based off structure and making sure that we aren't leaving money on the table because we have that pattern and that behavior going. So let's get into the details. Kyle, give us a scenario here.
Yeah, so we've got a business owner. This business owner is married, has 3 children. They're younger children, looks like twins because the two are both 5 years old. So twins and an 8-year-old. Sounds like, man, it sounds a lot like John.
Sounds like us.
Yeah. I didn't catch whether they're all daughters or if there's any sons in there. They are about 40 years old. This owns a business, is doing well in business, and the spouse is working a T4 job, which again, it's a great mix, right? So you've got some income coming into the household by force, we'll call it. And then we've got other income that gets to be a little bit more controlled, right? He gets to decide. So he gets to decide to take salary or dividends or both, depending on what the household might need. They have a good amount of assets on both sides of the quote unquote corporate border. So lots of good things going on. They own their primary residence and they have about, I'm going to put it in the range of about $350,000 of equity that is available
Okay.
to them that they are intending. And I'm going to say, I think it's more equity available, but this is the amount that they are intending to put into investments via, say, Smith maneuver. Okay. So
All
they've got
right.
Smith maneuver on the radar. When
They're
we
not
look
started the
to the
Smith maneuver yet. They're kind of like, this is where I want to go.
I think they have a small investment that they've made through some sort of private placement with some of the equity. So they have done some of it before, but it sounds like now they want to get into more of a routine around it.
Okay.
Okay. And I think that's how they found us on YouTube. We've got, many episodes, as you all know, listening or watching about the Smith maneuver in particular. And then they went down the rabbit hole of like, but what about on the corporate side of things? As
Mm,
many people will know, if you're earning income actively inside the corporation, inside an operating company, you are getting a tax benefit of a low tax rate on the first $500,000 anywhere in Canada. Okay. You're getting a tax benefit. It's going to be a slightly different rate depending on the province, but here in Ontario, it works out to about a total of 12.2% on net operating income of any number below $500,000. This individual is also in Ontario. So they're dealing with something like that. So what do we say? We say, listen, if you don't need to take the money out for personal needs now, it's great to kick the can and keep those dollars inside the corporation, keep them as whole as possible. And they've done a good job of doing so already. They've got about $800,000 inside the corporate structure that is, and actually more than that in retained earnings on the balance sheet, but about $800,000 that is split up amongst different assets.
okay.
About 60% in equities, commodities, silver, and so forth.
Okay.
And then about 40% split between cash. And actually, they have a high cash value life insurance policy in there as
Okay.
well. So they have about 50,000 in cash there and about 160 or so thousand of cash value already in this policy. So a typical 60-40 split. We see this a lot with business owners, right? Business owners need liquidity. They don't want to ever find themselves in a cash flow crunch. So a policy is a great fit to do that. So they're doing a lot of these great things already. And the question that they came to us with was around investing and around their concerns around passive income that's being generated
Mm,
in the corporation and their concern about the grind down rule. Okay. And the grind down rule, for those who don't know or are unaware, the more passive income we generate inside a corporation, not only are we being taxed as if you're in the highest tax bracket as an individual. So here in Ontario, at about just north of 50% on every dollar of interest or dividend income or any other rental income, for example, it's going to be painful on that front. But also, as we start growing more and more passive income each and every year, the government takes away how much of that small business tax credit you get. Meaning, basically, they're saying, listen, this was for small businesses, and if you're generating enough passive income each and every year, I guess you're not that small of a business anymore, are you?
hmm.
Right? It means like you're investing in passive income generating things. You are not focused on growing your operating business, and therefore
Right.
we're going to start clawing back some of that cheap tax dollars. And here in Ontario, if it's fully grinded away or ground away, I'm not exactly sure of the appropriate word for it, you'll all of a sudden be earning operating income at 12 or 26.5%. So it's a significant jump. You're going to pay more than double tax on the active income. So passive income is a real concern, and deciding how you can ensure that you are essentially being smart about
Right.
keeping your passive income low and doing other things to keep the money growing in your corporation in a tax
Right.
incentivized way or a tax optimized way is a
Sure.
really important move.
So it sounds like, just a quick summary here, he had a 60-40 split inside the corporate structure at, an ETF portfolio, commodities, we got a bunch of assets here that are growing in value and in a way giving us a little bit of passive income. And if we keep going in this strategy, that might have some tax disadvantages moving forward. So he reached out to us to go like, what should I be doing now? When he reached out to us, Kyle, specifically, what was he thinking of doing? Like, what was his plan moving forward? Was it just to keep investing? Like, knowing that the tax grind down rule is going to affect him, was he like, what should I do? Or like completely like, I have no idea. Or like, here's what I think I should do.
Right.
And you're like, let's go forward with that. Or like, actually, you should try this.
Yeah, and actually, I think I should backtrack here because I left out a key detail. Remember, there was a discrepancy between the investments of about 800,000 and his actual retained earnings on the balance sheet. And in my head, as I said it, I was like, where did that other money go? And it's in private lending right now.
Oh, right.
Okay, so he's
Okay.
got money out in private lending. So he has
Sure.
sent money out. And of course, when you're doing private lending, you are typically earning a favorable interest rate. Now, we didn't get into the nuance of exactly what the percentage was, but let's pretend it's around 10%. And that is considered passive income. So he is now approaching this challenge where his accountant is saying, there's a lot of passive income being generated, at least to a point where it could become a challenge in the future, right? And as we mentioned, if you earn more than $50,000 in passive income, you are going to slowly grind away at your active income small business rate that you've been getting. So, okay, so this is what he's looking to try to essentially protect against. So now the initial conversation started with the idea of going, you know what? I'm thinking about doing an immediate financing arrangement. We've discussed this on the podcast before. This is where we fund high early cash value life insurance and we immediately lever it. So right away we go to usually an independent or a third party lender. It could be a big bank, it could be a private capital firm, it could be anyone. We say, listen, I'm putting this policy in place. I'm going to put X number of dollars of premium in every year. And here's what the illustration looks like. Can you give me 100% of cash value on that? And typically they say yes. So in his mind, he's going, if I do that, he's already got a small policy that has grown to become relative, an important amount, important size, about $160,000 of cash value that is corporate owned. But ongoing, that's not going to be enough for him to do an immediate financing arrangement and deal with this passive income because he's got an ETF portfolio. I said it was equities, but in reality, it's still spitting off enough dividends that's a problem. And this private lending, which he wants to do more of, right?
I see.
Once you get the taste of private lending and you see that cash coming in, you're like, I want to do more of it.
And that's why he wanted the IFA?
Goes wrong, of course, right?
Is that why he wanted the IFA? He's like, I just want access to some more capital to lend out.
Exactly. And really in his mind, and he's on the right path that he's going, listen, if I borrow against the cash value of this policy, I can do it inside the corporation. And there's, of course, going to be interest on the loan against the policy, which is the cash value loan that you're taking. That can be written off against some of his passive income. So he kind of gets three wins here, right? He's going to get the policy that's growing each and every year tax-free, which is good. That's awesome. He's going to get the future death benefit that's going to pay out through the capital dividend account to the estate tax-free. Awesome. Amazing. And what he's going to get is he's able to reinvest those dollars, having his dollars invested in two places at once into a high, interest earning investment here
that he's happy with.
And he'll be able to essentially offset some of the costs that he'll pay in tax by simply writing off the interest on the loan against the interest he earns on the private lending. So on the right path, but imagine if there was a world where maybe we can do this even better.
Well, so what do you mean saying even better? So like, what's wrong with the move? Nothing's wrong with the move. It's just like, no, you're not fully optimizing you and making use of all of the options available to you between your corporate life and your personal life. Is that what you're saying?
That's exactly it. Because what he has going on is in his mind, right? As we mentioned, there's more than just this thinking going on. And every time we hop on with a client, we look at their full picture, right? And I usually draw really, crazy looking pictures, and I try to show, your personal side, your
Sure.
corporate side. And of course, it's at a very high level. But if you recall earlier in the conversation, he was planning to do some maneuvering on a
Yep.
personal level. And I then started digging in and saying, like, so what's the plan over there? And, and to be honest, this client at first, I think, was sort of like, he's kind of like me. He's a fact finder. He's like, I want to know about this thing. And he wanted to focus just on this thing. And I really kept pushing to say, what are you going to be planning to invest in on the other side? Because it matters. And why it matters is, let's pretend we put an IFA in position. We, max funded a policy. We got a bigger policy going so that he can do this. He could go all in on private lending. He's going to be way further ahead than if he just took all of his retained earnings and put it into private lending. And then the grind down rule takes over. Now he's paying more tax on active income. He's paying 50% on the interest he's earning in private lending. Like, not a good situation. So just by doing the IFA on its own, just plain Jane, he's going to be well ahead. That's a good thing. So we're already better. But if we can make this even better, if we can go to the next level and go, let's optimize, because remember, this isn't just a company. This is you personally as well. This is your family. This is all of the other assets that you have. And at the end of the day, it all comes out in the wash as to who owns it. It's you and your spouse that own all of these things. So imagine that we can be a little smarter about where we earn income so that we can take advantage and have more control over the tax that we might pay. That's where we want to get our heads going. So while I'm going to still be in favor of an IFA, what I wanted to know from him is, what do you plan to invest in with the Smith maneuver? And what he came back to me with was a very, I'll call it, we'll call it a typical asset mix portfolio, having equities and fixed income on the personal side. And that's when I said, based on that, it sounded like too, he was trying to be a little bit more conservative in terms of what he was aiming to achieve or what he was aiming to do, and on the personal side. And that's because he's lending against or borrowing against his personal or primary residence. And what we started to discuss is how, if he was going to instead do what investing he was going to do with the Smith maneuver in the corporation and focusing more on capital gain like equity assets, and take that private lending and actually do it at a personal level, what he's able to do, he's still going to get an interest write-off in both scenarios. The IFA is going to generate an interest write-off. Why? Because it's an investment loan. The same is true when he borrows against his primary residence. He's going to borrow, and because it's an investment loan, he can write off the interest there.
Right.
The difference is, if I can earn that private lending income at a personal level, I get to claim it at my personal tax bracket instead of the passive income tax bracket inside the corporation. I now have full control. And why I say full control is because, remember, he's a business owner. So he doesn't have a forced T4 that he has to take. He can design this such that maybe a good chunk of his personal income is going to come from private lending. And therefore, he actually doesn't have to take as much of a salary or dividend at a personal level. He gets to keep more money in the corporation to grow and compound in there. And he's able to take a much lower tax payment or tax due or owing on that 10 or 12% interest that he's been paying at passive income tax rates inside the corporation.
Did you discuss, because that makes a lot of sense, like you're trying to optimize the tax, which tax you're going to pay at which level, and if we've got a lower level at personal, then we would be getting it for passive income at the corporate level. Let's try to transition or shift one asset strategy from one bucket to another to take advantage of that. Did you discuss shifting, say, that more of the what he was planning to do with say investing with the Smith maneuver on the personal side into the corporate side? Like, was it like, let's put those assets inside there, and therefore are we still are they still passive income sourced, and we're not eliminating that issue, or are we actually solving for that issue over there because now they're not dividend paying assets that really are accumulating passive income anyway?
Yeah, well, the beauty is, so if we can take as much of the passive income generating assets and have them invested at a personal level, so if he's taking them out over here and he's earning, say, 12% over here, whatever he's going to pay in tax is going to be dependent on his own tax bracket, which again, he gets to control here. So
Right.
he can choose to take no income from his corporation, and therefore whatever he generates on this investment, right, is going to be what's coming to him. Now, at 10 or 12% a year on, say, $300,000, like, we're only talking about $30,000 to $36,000 of income. That may not be enough for him. So he might still need to take some money out of the corporation via dividend or a salary. I'm going to recommend a small salary is probably the way to go there. But the beauty is that might keep his tax rate. If, let's say, all he earned was the $36,000 off of this, he's going to pay a very low rate. He's going to pay like below 20% on that amount, probably closer to 15%. Where he is on that amount instead of 50%
Right.
on that 12% over here. Plus, he's going to get a write-off against the interest here. Now, has he completely eliminated tax at all in the
No.
corporation? The answer is no. It's not that he's completely eliminated tax, but he has more option. And when he goes and he decides to fund his policy, which he is then aiming to put into instead now, he's going to, instead of the stock portfolio he was going to invest in here, he can do that over here.
Here, meaning like you're referencing inside the corporation.
Inside the corporation, yes. And actually, sorry, my friends who are
It
listening,
looks
right
like you're
now,
trying to draw something.
I'm
No one can hear
drawing
you.
on the screen. So those who are on YouTube with us, just, type in IFA or type in private lending. We'll put in some keywords there so it pops up and you can hop into this video for Canadian Wealth Secrets. But over here, I've got a big box which represents his corporation. And really what we're going to do is we're going to over time take retained earnings and we're going to try to get, I'm going to say, as much as you want to get into a policy. For me, it's as much as I can get in. And the reason why is because I know eventually these retained earnings are going to be taxed at a personal level by someone, me, my spouse, my kids, a charity, someone. So I'd rather get it to touch a policy, grow and compound tax-free, and be able to pay the net death benefit tax-free out through the capital dividend account. So right there, you're going to get a estate value that's going to be way better over time. And every year it's going to get better and better. He's now going to invest in the stock portfolio that he originally was going to invest in with the Smith maneuver on his primary residence. He's instead going to do that in the corporation. So I want to pause here for a second. The risk has remained exactly the same.
Right.
All we've done is we've just swapped where we're going to make these investments. So I'm not telling him to change what he invests in. He gets to choose what the right fit is for him. And I'm in full support of that, and here all we're doing is we're flip-flopping where it happens. So some people go, I'm kind of nervous blending against my primary residence in order to earn this high 12% return. You were taking the same risk inside the corporation. It's all your capital. It's all your income. The only difference is now you're going to get to keep more of it. You get to keep more of this passive income here at a personal level, And over here, the one difference I might have him change is that any of the conservative plays he was going to make that create passive income, that he look for equivalent ETFs that actually reinvest dividends and interest and such inside of the trust so that it's actually not going to be deemed as passive income and it will instead be deemed as a capital gain. Now, capital gains taxes are still not fun whether you earn them here or you earn them there. But as of today, we no longer have this 2/3 inclusion on the table right now for incorporated business owners. So we don't have to actually worry about paying more on the capital gain or less. You actually are going to be paying the same amount as of today, as of recording this here in 2025, which means you are in a net better situation because you're keeping more of this private lending income. You're going to keep this. I'm going to say you're actually improving in this part as well, because he was going to take dividends at a personal level over here with this stock portfolio. I'm encouraging inside the corporation, we try to pick ETFs that are going to create capital gains instead of dividends so that you can kick and you'll get taxed at about, we'll call it around 25% of the total capital gain is what that's going to work out to, plus any of the tax-free portion of the capital gain. Right now, 50% can come out tax-free through the capital dividend account upon any sale, any realized capital gains. So just by doing this one flip-flop, we now have a massive, massive improvement to the overall long-term trajectory. We don't even have to run the numbers on it because, again, we're not comparing different investments. We're just comparing what we get to keep in our pocket versus what we were going to send off to the CRA.
And when you strategize this with him on the call, what was his next step?
So his next step right now, first of all, at the end of the call, he went, that is more than he was looking for, right? Because now he's like rethinking some of the ideas that he was going to put in motion. Initially, he was talking about just getting an IFA going. So he's still consistent on the idea of an immediate financing arrangement inside the corporation. We did discuss personal leverage against corporate assets. We talked about how that's possible in the future as a policy grows. However, we also discussed how at that point in the journey, there's probably going to be more convenient assets in his world, i.e. his primary residence, that he might choose to use that leverage against with the same logic in mind here, right? Right now, we're saying, listen, you're leveraging against two different assets to make two different investments. We flip-flop them. The same will be true as he does this work and he continues to grow his net worth and grow his assets in his life. He will have an option down the road to leverage against different assets in order to create more cash flow in his life without triggering additional taxes. That could be against a corporate asset. But with doing that comes other things we have to do, like paying our corporation for the right to do so, like making sure we get independent legal tax advice, like doing all of these different things that may be more work than they're worth when we know that we have other assets on the personal side that we can use the same leverage against without as much hassle, without as much cost. But you have the asset, we call it the foundational asset, sitting inside the corporation, which is giving you the optionality to feel confident to use that type of conservative leverage. Whereas if you didn't have it, you probably wouldn't use leverage against, say, your personal or primary residence at some point down the road. So here it's all about optionality and creating yourself the right plan so that you are in a position to do the best move for you now, medium term and long term, so that you can maximize cash flow and maximize your net worth while keeping your legacy and your estate intact.
Yeah, and these are the types of conversations we often have with folks who reach out to us who are in, say, phase 3 of their wealth building, journey, which is about protecting your hard-earned your money, you're protecting your capital, protecting the amount of in your nest egg, the growth that you've been working towards, your independent financial number. That's the focus of phase 3 is how to grow that, but also protect it and structures that protect it. Those are the types of conversations we have with our clients in that phase. Phase 2 is about kind of just awakening and accumulating assets that are, say, income producing assets, and how do we structure that. Phase 1 is like the awakening to focus on assets versus, say, making sure that you're covering all debts. Phase 4, I'm jumping around here in the phases, but phase 4 specifically is some higher advanced strategies that some of our high net worth clients, some of our business owners can take advantage of around fully optimizing the tax structures that at a complex level. So If you're unsure of the phase you're currently in, you can head on over to CanadianWealthSecrets.com/discovery. We have a short survey there for you to fill out to help you, discover which phase you are in. That link will also get you an access to, say, have that conversation with us so that we can kind of navigate your unique situation and develop a strategy that best meets your financial journey.